Welcome, curious minds. Today we're really digging into Ajax Engineering Limited. They're a pretty key player in India's infrastructure boom, as you probably know.
Absolutely. A major name.
So our mission today is to unpack their latest financials. This is for the quarter ending June 30, 2025. We want to understand their strategy, how they fit into this whole picture of India developing so rapidly.
Right.
We've got their unaudited statements, the review report, press releases, investor stuff, basically trying to get you the full picture.
And what's really interesting here, I think, is that it's not just about the numbers, right? It's about how a company like this, right at the front, handles new rules, market
All
changes.
depths, yeah.
Exactly. And how they're setting things up for what comes next. So you should get a really clear sense of where they stand and where they're headed. Hopefully that aha moment.
That's the goal. Exactly. So let's get into it. Okay, first things first, the headline numbers. Q1 of their fiscal 26, ending June 30th, 2025. The board just approved these August 2nd after the audit committee look.
Yeah, fresh off the press, basically.
So what jumps out? Revenue from operations. Looks like ours,
Yeah.
4,665.15 million.
Right, which is, well, it's only a tiny dip, really, about 0.5% compared to the same time last year.
Yeah.
That was ours, 4,690.04 million. So revenue's holding pretty steady.
Okay, steady top line. But what about the bottom line?
Well, that's where you see more of a shift. Profit after tax, PA, that came in at ours, 528.75 million.
Okay.
And that's down 21.1% from Q1 last year. Quite a drop. That also pulled their PA margin down from 14.3% to 11.3%.
Okay, 21%.
Yeah. And EBITDA saw a similar trend, down 23.4% to Rs 614 million. So the EBITDA margin fell too, from 17.1% to 13.2%.
So definite pressure on profitability. The MD and CEO, Shrihabrata Saha, he actually called it a quarter of challenges and transition.
Makes sense.
He mentioned things like, well, unseasonal rains, which can slow things down.
Always a factor in construction.
Right. And this big one, the change in emission norms to CEV5. Plus, he said, a slower pace on some projects. But he also stressed they're still focused on capability building and execution excellence.
Building for the future, even with headwinds.
So this margin pressure, why exactly? Was it just the transition?
Well, the CFO, Tuin Basu, gave some clarity there. He basically confirmed margins got squeezed by a shift in the product mix and higher costs tied directly to the CEV5 transition.
Okay, so the new emission standard.
Exactly. CEV5, that's Construction Equipment Vehicle Stage V. Much stricter rules for engine emissions. It's a big deal. Requires investment, retooling, maybe higher component costs initially.
Right, so it costs money to comply.
It definitely does. But he was quick to point out the company's still fundamentally strong. Importantly, they're debt-free, have a healthy cash balance. That's crucial, gives them breathing room during shifts like this.
Good point. Having that cushion is key. So it sounds like a strategic hit they're willing to take for long-term compliance.
That's how it looks, yeah.
Yeah.
Prioritizing the future, even if it hurts a bit now.
Okay, so let's break down where that revenue actually came from. Ajax is pretty focused, right? Just the one segment, making concrete equipment.
That's right. Their main thing is the self-loading concrete mixer, the SLCM. They're basically the world leader there.
Yeah, huge market share in India, something like 69%.
Around that, yeah. And that core SLCM business held steady, generated Rs, 3,848 million this quarter, which is pretty much flat compared to last year. So the core is stable.
Okay, stable core. But what about the other stuff, the non-SLCM equipment?
Now that part is interesting because the revenue from non-SLCM actually went down by 7.6% to Rs 448 million.
Okay, down.
But, and this is the catch, the company reported that the volume of non-SLCM equipment they sold actually grew by 25% year over year.
Wait, revenue down, volume up? How does that work?
Exactly. It points right back to what the CFO said, product mix changes, maybe some pricing adjustments. It could be those CEV5 costs hitting the newer non-SLCM products harder. Or maybe they sold more lower-priced items within that category.
So selling more units but maybe less profitable ones, or feeling the transition pinch more there.
Something like that. It definitely warrants watching how that mix evolves.
And then there's spares and services. How did that do?
That was a bright spot, up 7.9% to Rs 369 million.
That's always good to see, right? Spares and services growing.
Absolutely. It often signals a healthy installed base, good customer relationships, recurring revenue. It's a sticky part of the business.
And what about outside India? Exports.
Exports were about 5% of the revenue in Q1, which might seem small, but you have to remember, they've already built a pretty significant global footprint. They've got, what, 28 distributors in 51 countries?
Yeah, that's quite a network already established.
So it's not just about reacting to the market. They're making proactive moves, too.
Right, beyond just the quarterly numbers, what strategic things are they working on?
Well, the big one is finishing that CEV5 transition. They managed to sell off all the older CEV4 inventory by the end of Q1.
Ah, okay, so clean slate from Q2 onwards.
Exactly. From Q2 FY26, their whole portfolio is CEV5 compliant. That's huge. It aligns them with the regulations, future-proofs the product line. Done deal.
That's a major milestone ticked off. What else?
They're also pushing hard on expanding their B2B go-to-market channels,
Mm-hmm.
really focusing on the top 8 metro cities in India,
Wide focus there.
trying to boost sales to bigger institutions and specifically drive those non-SLCM product sales, which, as we saw, need a bit of a revenue boost despite volume growth.
Makes sense. Targeting bigger buyers.
And tied into that growth ambition is capacity. They've got a new plant at Anara in Hosali, a big mouthful.
Ah, yeah.
They plan to get that commissioned in the second half of FY26. This is supposed to be the foundation for, scalable, more diversified growth,
Yeah.
adding to the 4 plants they already have near Bengaluru.
So investing in future production muscle, too. Okay. And speaking of the corporate side, they had that board meeting on August 2nd. Anything else come out of that besides approving the results?
Yeah, a couple of key appointments, actually. Shows they're focused on governance. They appointed a Mr. A.N. Sriram as cost auditor for this fiscal year. He's got like 30 years of experience.
Yeah.
And for internal audits, they brought in PwC, PricewaterhouseCoopers.
A big name. So beefing up the oversight.
Definitely looks like it. Just strengthening those internal controls and governance structures. They also set the date for their AGM, September 5th, via video conference. Standard procedure, but shows ongoing transparency.
One thing that really stands out when you look at Ajax is their history of innovation. It's not just recent.
Oh, absolutely. They've been at it for a long time. They have, 71 people just dedicated to design and engineering?
Yeah. They brought the first SLCMs to India way back in '92. That was pioneering stuff then.
Total game changer for smaller sites. And they haven't stopped. More recently, they added SLCMs with load cell technology.
Load cell. What does that do exactly?
It's basically about precision. It uses sensors to weigh the materials, sand, cement, aggregate, water, very accurately as they go into the mixer drum.
Ah, so you get the exact concrete mix every single time.
Precisely. It ensures consistent quality, which is super important for, big infrastructure projects or anything where specs are tight. Government departments are apparently recognizing it now, too.
Quality control built right in. Smart.
And they've developed other things, too, like self-propelling boom pumps designed for tight city job sites. And they were the first Indian company to build their own slip-form paver back in 2019.
Wow, in-house.
In-house, yeah. And then just last year, 2023, they commercialized a 3D concrete printing machine. So they're constantly pushing the envelope. That R&D focus is clearly a big part of why they lead the market.
It builds a real competitive advantage over time. What about how they actually make things, their operations?
Yeah, they seem pretty sophisticated there, too. They talk about using a lean manufacturing model, things like and-on systems.
And like the cord you pull on an assembly line.
Sort of, yeah. It's a visual system. If there's a problem, an operator flags it immediately, lights might flash, production might stop locally until it's fixed, prevents defects from moving down the line.
Okay, efficiency.
Exactly. And JIT, just-in-time production. Making only what's needed when it's needed, cuts down waste, inventory costs. They've also got a huge supplier network, over 630 of them.
Mm-hmm.
And interestingly, less than 10% of their materials are imported. That suggests a pretty resilient supply chain, less exposed to global shipping issues maybe.
Good point, especially these days.
And then there's their reach in India. 52 exclusive dealers, 114 customer touchpoints, dedicated service staff. Their customer base grew 23% between FY22 and FY25. Shows loyalty, and apparently no single customer is too dominant, so less concentration risk. It really does sound like a well-run operation.
Okay, so we've got the quarterly numbers, the strategic moves like CEV5 and expansion, the operational strength, the innovation. Let's zoom out. What does this all mean in the bigger picture? For you listening, how does Ajax fit into India's whole growth narrative?
Yeah, that context is absolutely critical. I mean, you can't build modern India without cement and concrete, right?
Mhm.
Roads, bridges, buildings, renewable energy projects. It all needs concrete.
Foundational stuff.
Totally. And India's per capita cement consumption, even now, is still way below the global average. It was about 260 kilograms in 2023, roughly half the world average.
So huge potential just to catch up.
Massive headroom for growth, exactly. And forecasts show domestic cement consumption growing at maybe 8% a year through FY29. That's a strong underlying trend.
Okay, so the basic material demand is growing, But where does Ajax equipment fit in?
Ah, this is where it gets really interesting for them. The trend isn't just more concrete, it's how it's made. The move is towards mechanization.
Away from manual mixing.
Definitely. The mechanized concrete equipment industry in India, that's Ajax's playground, is expected to grow much faster than cement itself. We're talking a projected 24% compound annual growth rate between FY24 and FY29.
Wow, 24% CAGR.
Yeah, going from about Rs 61 billion to potentially Rs 178 billion. The share of mechanized equipment versus manual methods is set to increase significantly. It's a clear industry shift towards efficiency, speed, and quality.
And Ajax is positioned right in the middle of that shift.
Perfectly positioned. Their management sounds confident about the long term because of this. They expect things to pick up momentum again in the second half of FY26 construction, often has seasonal dips anyway.
Right.
Their long-term plan seems pretty clear. Keep dominating the SLCM market, build up that non-SLCM side, sell more internationally, and maybe even look at acquisitions for growth.
So basically, they're betting on this mechanization trend, plus the government's infrastructure push, and the fact that everyone will increasingly need compliant, modern equipment like their CEV5 range.
That sums it up pretty well. It's a long game, leveraging some very powerful macro trends in India.
So wrapping things up, we've taken a pretty deep dive into Ajax Engineering's Q1. We've seen them navigating some definite challenges, the CEV5 transition costs, market stuff, but also strengthening their core operations and keeping that innovation engine running.
Yeah, and we've connected that to the bigger picture, this huge potential in India's infrastructure story.
What really stands out, I think, is how they're managing short-term pressures while clearly keeping their eyes on the long-term prize. That focus seems unwavering.
It's a good case study, really, of how these foundational industries adapt and position themselves for the future.
So what's the takeaway for you? Maybe think about how this mixed innovation, operational grit, adapting to regulations could be a model for other companies facing big changes or big opportunities.
Right. How can navigating those headwinds now, like the CEV5 shift or the temporary slowdown, actually make them stronger for the growth that seems likely down the road?
It leads to that question, doesn't it?
hmm In what ways can a period that feels like challenges and transition actually become a catalyst, a chance to build deeper capabilities and really set yourself up for future success, rather than just being a setback?
Something to think about. That's it for our deep dive today. Keep learning, and we'll catch you next time.